Going into the July 2026 FOMC meeting, expectations remained standard. The Federal Reserve held rates unchanged. This chart tracks the intraday market reaction, revealing a severe twist steepening of the yield curve. The 2s30 spread surged, pulling 30-year Treasury yields to new highs. The most aggressive acceleration occurred during the Q&A session as the chair addressed the press. We have rarely observed this specific price action. Over the past decade, post-FOMC twist steepeners occurred in only 20% of instances. The primary catalyst for this shift was the commentary delivered by Kevin Warsh, navigating his second meeting as Fed chair. Market participants processed his remarks as a hawkish surprise. This move signals a shift in the Fed's long-standing reaction function. The twist steepening represents a loss of market confidence in the Fed's historical policy anchors. It forces a reassessment of forward inflation pricing, operating independently of the current policy rate. To understand the bond market's reaction, we have to isolate Warsh's response to questions about the 2% personal consumption expenditures mandate. He offered the target only lip service. This compares a strict core PCE target against a wider band of inflation metrics. Warsh explicitly stated he's evaluating a broader set of data. Since core PCE sits at the upper boundary here, expanding his lens introduces a downside bias to future policy rates. The second warning sign emerged when Warsh addressed the effectiveness of the Fed's tools. He argued that the Fed funds rate and the balance sheet operate through distinct transmission mechanisms. He suggested interest rates manage credit channels, while the balance sheet handles signaling and portfolio balance. He implied the balance sheet will take on more of the heavy lifting in fighting inflation. Prior institutional models assumed a slow, passive approach to balance sheet runoff. Warsh's comments point to an active balance sheet, actively compressing the front end of the curve while the long end rises. Because the balance sheet is a primary driver of the curve slope, a more aggressive shrinkage directly supports further bearish steepening. By signaling active balance sheet utilization and de-emphasizing core PCE, Warsh has introduced the risk of long-run inflation expectations becoming partially unanchored. To act on this regime shift, we must translate Warsh's commentary into a quantifiable structural dislocation on the curve. This chart maps historical consumer price index levels running above core PCE. The gap between them is the core CPI-PCE wedge, which has acted as a persistent structural headwind for inflation-linked assets. Because policy was anchored to core PCE, monetary policy ran hotter than was typical for the actual level of CPI. This dynamic kept market-based inflation expectations artificially suppressed. The front and belly of the yield curve are the tenors most exposed to this narrow wedge. Warsh's shift to broader metrics changes this. The market now anticipates a more dovish policy alignment relative to current inflation prints. As the historical headwind from the CPI-PCE wedge fades, it creates a structural mispricing in forward inflation rates. This data table displays a statistical regression model testing inflation rates across various tenors against the CPI-PCE wedge to pinpoint where the mispricing is highest. The spot 5-year tenor shows a high partial coefficient of 16.7 and a T-stat of 19.4. At the long end, the 30-year tenor sensitivity drops significantly, with a coefficient of only 10.5. The most significant anomaly is in the forward space. The 5-year forward 5-year tenor commands a 17.4 coefficient and a 33.9 T-stat. This coefficient indicates that the 5Y by 5Y forward space exhibits the maximum sensitivity to the fading wedge. Using the forward curve is essential when long-run inflation expectations are at risk. The quantitative regression dictates that capital should be deployed in the belly of the forward curve to capture the repricing, rather than the long end. A successful entry requires an instrument with an asymmetric risk-reward profile. Cash break-evens are currently burdened by the technical headwind of negative carry. Inflation swaps bypass this cost. Forward 5Y by 5Y inflation swaps also face approximately zero roll-down risk over the next 3 months. We can screen the valuation of this swap against its historical ranges. The 5Y by 5Y currently trades at 239 basis points, which is roughly 13 basis points below its fair value estimate. With a z-score of -1.2, the instrument is trading near the bottom of its 3-year range. The combination of zero roll risk and a statistically extreme valuation floor creates a highly defensible entry point for a widening strategy. Revisiting the 5s 30s curve technicals, we see the recent surge from tactical support near 70 basis points. Previous flattening trades hit their stop-out levels as the curve steepened back into the 82 basis point retracement zone. A break through the 80 to 83 basis point range would target the 88 basis point Fibonacci confluence, further supporting a bearish steepening view. Monetizing this unanchored regime requires an execution focused on the belly of the forward curve. The strategy aligns on 3 levels. First, the shift to broad inflation metrics removes the CPI-PCE headwind. Second, the 5Y-X5Y swap captures maximum sensitivity to the wedge with zero roll-down risk. We recommend initiating long 100% risk, or $56.4 million notional, of 5Y-X5Y zero-coupon inflation swap wideners. Executing this forward swap provides the optimal architecture to profit as the Fed deprioritizes its singular commitment to core PCE.